morning and welcome to the 107th episode of the Veritas Fact Finding Series. And today I'm joined by our special guest, Mr. Jon Shell. Good morning, John.
Morning. Nice to be here.
In each episode of our fact finding series, we go on the ground to speak to industry professionals in an unscripted, candid video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. If you're watching and you like what you hear, give us a like and follow us at www.veritascorp.com. By way of background, my name is Anthony Shilapati. I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada. I'm proud to say this year we're going to be celebrating 23 years, 100% employee owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas group of companies may own securities discussed in this broadcast. And while we love all our guests, and John in particular, this session may contain forward-looking statements, investment opinions that we may not agree with at all. Now, quick comments on John and the timing on this discussion about employee ownership trusts is fantastic. Just coming off the federal budget. John, he's the managing director and partner at Social Capital Partners, and I'm going to let John provide more information about that, but it's an independently funded nonprofit founded in 2001, whose mission is to build a more resilient economy through broad-based ownership and equity employment. And the current focus is very timely. It's about increasing employee ownership in North America through both regulatory change in Canada and partnering with institutional investors to finance large-scale employee ownership transactions in the US. Prior to joining Social Capital Partners, John co-founded the largest veterinary service providers in both Canada and Australia. He worked as a management consultant at McKinsey and Company, and once owned and operated a used goods store in a plaza in central Toronto. We're going to talk a little bit about that. That's very interesting. And he has a BA from Queen's University and MBA from Western. Good morning, John.
Good morning.
John, I'd like to start out with all our guests to ask them, tell us about yourself. Like, how does a guy who studies at Queen's, does his BA, then does his master's, is clearly an entrepreneur, builds a business, scales it, sells it, and now goes on to let's call it more social enterprise. Why does that happen? Walk us through
that. Sure. I mean, it's a bit of a roundabout journey, and hopefully won't be too boring to your audience. No. When I left my MBA, I did first of all, I did that used goods store, which was a bit of a detour and certainly put me behind, as it were, on a career trajectory, but was lucky enough to get into business school, worked at McKinsey, but always wanted to get back out into entrepreneurship. Left McKinsey relatively quickly to start buying veterinary practices here in Toronto with my business partner. Left that business after 7 years. I along the way married an Australian who said, we're moving to Australia. So I moved to Australia, which kind of required at least a partial exit from that business. That business largely scaled without me. We were at sort of 13 practices. I think had agreements signed to get to 16, but my partner was the one who really scaled it to the size it is today. And then moved to Australia. I intended to retire. I was 37. I started learning how to play golf, and after about 3 or 4 months of that, was so unbelievably bored that I had to stop. I remember being on a driving range and I'd hit like 200 balls, and mostly badly. And it's like, what the hell am I doing here? So I put the golf clubs away. I've largely not touched them since. I started another veterinary company in Australia and grew that. And look, I think in the process of being in the veterinary industry over the 12 years between 2006 and 2018, call it, that industry changed pretty dramatically in a way that made me a bit uncomfortable about what was happening in the economy more broadly. when we started, we were buying practices that owners were unable to sell to other people. They wouldn't have had an associate, that was willing to buy their practice. So they needed somebody to buy them, and we were an answer to that. And that was good. It was useful. It was productive. And then, over the course of the next 10 years, as interest rates were zero, as pension funds began to accumulate massive sums of money, tons more interest in private equity. And private equity decided that veterinary was an important industry for them to be in. And so all of a sudden, the price of veterinary practice started to rise.
Like everything else.
Like everything else. And so, obviously this was happening in many other industries. But what I was struggling with, by the end of my time in Australia, was that, this industry that had been a pathway to wealth for professionals for a very long time was not as much a pathway to wealth anymore, right? So the traditional path would have been, I'm going to become a veterinarian. I'm going to join a practice. I'm going to get to know the owner. I'm going to work with them. And eventually I'm going to buy them out.
Yeah.
And that buyout is going to be supported by the bank. I'm largely not going to have to put up much of my money. I'm just going to need to put up my effort. And the bank was comfortable with that because the price made sense, right? You could pay it back over 5 to 7 years. It all kind of fit. As the price of a veterinary practice went from 4 times cash flow to 8 times cash flow to more over that time, that pathway started to break down. And we were starting to buy practices in Australia where there were deals already in place between the owners and a veterinarian that were broken because we were willing to offer that much more money. And, it's not that the companies that were created are bad companies. They're good companies and, thoughtful employers and all of that. But, it caused me to think more about what was happening in terms of the influence of finance on ownership. Mm-hmm. And so I started to look a little bit more deeply into that. And, along the way, I got paid a whole bunch of money, right? I've sold the shares in both of those companies. The prices for those companies were far greater than anyone ever thought was possible. So I consider myself to have been vastly overpaid for my engagement in the economy. And sort of came back to Canada in 2016, and still a bit involved in the one in Australia, just wondering about what my purpose was, like what my role was in society. Had I done a useful thing or had I done a not so useful thing? And what are the things that I have learned about how business works, what's happening in finance, what's happening in the economy that could be helpful in a more general sense. And so that's how I joined Social Capital Partners. Bill Young started this back in 2001. He has a relatively similar history to me in terms of, feeling like he was vastly overpaid for his work in the private sector and then wanted to do something a bit different. And so, very comfortable fit for me, and we've now gone and tried to figure out different ways to broaden access to ownership in the economy, of which employee ownership is one of our programs.
Okay, so let's talk about that specifically, because the timing on our discussion, we've got it, I think, nailed. As we've just heard from our government in the 2023 federal budget, they provided details on the employee ownership trusts. Why don't you explain to us a little bit about how the trust works, what it does, and how it might help, broaden the ownership base and keep it more within Canada. We see what's going on right now with tech and, trying to protect Canadian assets. As a smaller economy on the global scale, we're vulnerable to lots of takeovers. So let's talk to that.
For sure. And that's one of the many benefits of employee ownership. And Andy, would you mind if I step back a little bit and talk about how employee ownership works in other countries and sort of how we got to this? When we started looking into ways to broaden access to ownership in the economy, we looked around at all of the successful programs that do that in other countries. So both from a finance perspective, right? What are the things that we can finance that would help? And from a public policy perspective, what are the things out there that matter? And the thing that we found that was most powerful of all the things that have existed, trying to broaden access to ownership, is the US ESOP, which is different from the Canadian ESOP. The Canadian ESOP is known as a stock option plan, but in the US it's called an employee share ownership plan. It was started in the mid-70s, and I won't trace the whole history, but it established a program and a set of incentives to provide an opportunity for owners to sell to their employees that didn't require their employees to front the money, right? So a lot of owners would love to sell to employees, but it's a hard thing. Employees don't have the money. Can they actually take the risk? You know, yes, you can do a management buyout, but that's not exactly what people have in mind. They want a broad-based ownership by their employees. So the US set up a structure for this. And how it works is if I'm an owner, I can sell to an ESOP in the US, and I will largely fund that myself. So I'll provide debt for it. It's a leveraged buyout. So, you know, in most cases, I provide the debt as the owner. And then this ESOP now owns the company. They'll pay me back out of cash flow, right? So we'll have a loan agreement and I'll get paid back out of cash flow. And now the ESOP owns the company on behalf of all the employees who don't have to pay anything for their shares, and every employee gets shares. So now over time, the employees accumulate shares. When they leave the company, they sell the shares, everybody wins. And the reason why I'm willing to do that as an owner in the US is because the policymakers over many decades have said, this is a wonderful program. It has amazing outcomes. We would like to provide incentives for owners to do this. So if I'm an owner in the US and I choose to sell to my employees through this structure, I can defer my capital gains tax in a way that largely eliminates it to my estate. So I pay no capital gains tax. And then when my company becomes employee owned, they pay no corporate tax, right? So you know, now so the government has said, we're going to do two things here. We're going to reward owners who do this because of the outcomes are so good. And we are going to make the company itself more successful to keep it sustainable. And when I say the outcomes are so good, you know, this thing has been well studied over 50 years. There are 6,500 of them in the US, representing 14 million Americans who own $1.7 trillion in assets in their companies, so over 100 grand per person. And, you know, this is from like grocery clerks to shop workers, you know, to executives. And the outcomes are the companies are perform better coming out of recessions. They lay off fewer people. They default less often than other companies. They grow faster. And to your point, keep jobs local and are owned by Americans, right? So for, you know, America has the same question about foreign ownership as we do. They see this as massive outcomes. And then, of course, there's all these wealth benefits. Oh, and by the way, those wealth benefits are far more powerful for women and people of color than they are for everybody else. So, you know, these vast benefits, right, have been supported. So wonderful success. 250 new companies every year become ESOP owned in the US. And then in the UK, seeing that, you know, this success in the US, in 2014 brought in their own structure called an employee ownership trust. And they said, okay, we're going to create this trust and we are going to waive capital gains tax for owners who sell a majority of their company to an employee ownership trust. That happened in 2014. It has scaled dramatically since then. Last year, 300 businesses in the UK were sold to their employees, creating approximately 30,000 employee owners. And, you know, before I get into the Canadian side, I mean, I have had an opportunity to engage pretty deeply with this community, especially in the US. And it is a wonderful group of people, spans the political spectrum. You know, all of them, you know, genuinely trying to provide a real benefit to their employees, preserve the legacy of their business, keep jobs in local communities that they care about. And so it's been super powerful. I mean, I had a dinner with you know, one of the main, he's the CFO of Amstead, which is a 10,000 employee, 100% owned, you know, engineering company based in the Midwest. He told me that 2,500 of their shop workers had retired as millionaires, right? Because of the employee share ownership structure in that company. They've been employee owned for about 30 years. It is like an engine of worker wealth in the US that has been extraordinarily powerful. So we brought this, we said, okay, you know, we do some work in the US, you know, we can talk about that, but we put together a report for Canada and said, look, here's what's happening in the US, here's what's happening in the UK. Canada has none of these things. There is no similar structure in Canada. There are no incentives for owners to use a structure like this. We should have one. and here's a set of recommendations for what you should do. And over the course of the last couple of years, we've engaged with very interested parliamentarians from all parties on this topic. So we have Democratic support, we have conservative support, we have a lot of liberal support, to the point where the liberals said, you know, they put this in the 2021 budget, we're going to look into this. In 2022, they said we're going to do it. And we just got sort of in the 2023 budget, a proposal for what an employee ownership trust would look like in Canada. So that kind of brings us to today. And before we get into the details of that, maybe I'll pause there, Anthony, and if you want to dig into any of that stuff.
No, I think that's good. It gives a nice background to where we are. And so now what I understand about the Canadian employee ownership trust structure that's being proposed, it doesn't offer the same incentives. It kind of falls a little bit short. And maybe you can talk to us about what it does and what it doesn't do.
Yeah, I mean, I'd probably describe that as quite an understatement in terms of what we saw. Look, I think we were quite surprised. You know, there's a lot of support for this. We've just, you know, in January, you know, we were co-founder of something called the Canadian Employee Ownership Coalition, which is a group of, I think, what's now 75 leaders from across the country, from nonprofit, academic, business, etc., in support of this idea. And so the government put out a employee ownership trust proposal that included largely no incentives at all.
Yeah.
So the only incentive in the structure is that if you own a company and you sell to your a majority of your company to employees through this new trust, currently you can defer your capital gains tax over a 5-year period, right? So many of the people on this call, I think, will know this, but you can defer your capital gains tax over 5-year periods to match your proceeds. So if I'm going to get equal payments over 5 years for my business, I can do this today. I can pay 20% of my capital gains tax every year to match my proceeds. In this new structure, you can do it over 10 years. That's it. So if I get paid over 10 years, I can now pay 10% a year. I have to pay a minimum of 10% a year, but I can pay over 10 years. So
what about if it's extended to 20 years, the payout, or it's an indefinite payout? Because in the structures in UK and US, the payout is from the cash flow. It's not set at how much is going to be paid each year.
You're right. 100% you're right. You know, the repayment is done through whatever cash happens to be available in the company. You try to set up an amortization structure if you can, but if it doesn't get met, you're still going to be flexible about it because you're the owner of the company. But you're right, it could take longer. But even if it does, the net present value of that deferral is, marginal, right? Like we had, we worked with an accountant on this, and he said, "Oh my God!" So he kind of went and did the numbers in half an hour and came up with a number that on a $10 million sale, it was worth like $300,000 maybe, versus a full waiver in the UK.
Yeah.
And so, we would describe it as close to as no incentive as you can get. In addition, they've added new constraints that we've never seen before. So there's no restrictions in the US or the UK in terms of the activity of the company that decides to become employee owned in terms of their foreign engagement. So what this proposal does is limits it to Canadian companies where 90% of their activity is based in Canada. Right. So if you're a company that has an office in the US that provides more than 10% of the value of your company, you now no longer qualify for this trust in Canada. And they've also added some new elements that we've never seen in any other country around how trustees. So once you have a trust form, someone needs to be the trustee of that trust and operate on behalf of employees. One of the reasons why this has been so successful in other countries is that when the transition happens, it isn't like you go from a regular hierarchically, governed company, managed company, to one person, one vote, right? It doesn't become a co-op. It retains the structure that it had before in order to ensure stability over time, right? As an owner, like if I'm an owner of a 200-person manufacturing company in Mississauga, I'm not going to run out and turn my company into a co-op, right? I don't know what's going to happen the next day. I'm going to want that company to continue to run in the way that it's run for the 60 odd years that my family has run. I mean, that's kind of the standard, a type of owner who does this in other countries. It's a second generation owner, it's a first generation owner. who says, I don't have anyone in the family going to take it over. I really believe in this employee ownership and I'm going to transition it. And so the indirect governance allows for a smooth transition, right? And allows for no disruption in the way the business runs to the benefit of employees long-term because the value is retained. The Canadians have added an element that says prior to the transaction, the employees of the company need to elect trustees democratically among the employees, and that trustee will negotiate with the owner on the transaction itself. And then once it becomes employee owned, every 5 years, the employees re-elect a trustee or the set of trustees or elect new trustees. And, we think that there is a lot of value in having more employee engagement in businesses for sure. But I think it will, if you're an owner who's contemplating this and you need to now go and tell the employees of your company that you're considering selling to them, they need to elect a trustee to negotiate on their behalf. And then what if the deal doesn't happen? Right? I mean, now you've set this expectation. And so in the US, the owner appoints a trustee that has a fiduciary responsibility on behalf of employees, who has to negotiate on the employee's behalf, but the employees don't know yet. In the UK, the owner appoints the trustee directly, the trustee doesn't get appointed till after the transaction happens, but there are rules around fair market value. So there are ways in which you govern the fact that make sure it's a fair transaction and nobody's cheating on taxes. But in Canada, they've introduced an entirely new level to this thing where I think if, as someone who has owned a company and where this would be a very appealing thing to me, philosophically, I would really worry about informing the employee base that I'm considering this in the event that something happens that causes it not to work. Because then I don't even know what happens to the culture of the company after that. So there's a qualifications issues with what has been introduced. There are incentive issues with what's been introduced. And there's new stuff that we don't have any, we have all this evidence in the US and the UK on what works. And then a bunch of new stuff has been introduced that we don't have any evidence of. Maybe it'll work, maybe it won't, but it's just new.
Can I ask what their problem is? Like, why do you think that they did what they did, given that we have, we have decades of experience in the US. We have nearly a decade in the UK. And we also have some experience here in Canada that, I guess none. This is going to be brand new now, right? So
I mean, we have, so there are Canadian employee-owned companies, right? So Elliston, PCL, Shandon, Friesens. There's a great company in Calgary, and I'm just blanking on his name, Spartan Controls, I think it is. So companies that have figured out how to make it work, right? With the current structure.
Not with the same incentives.
With no incentives, right? Who have just decided to do it. But very few, right? It's, maybe there's 50, right? Compared to like thousands in the UK and 7,000 in the US. And they didn't even use those models, right? As the basis for it. So, it's a frustrating time, to be honest, Anthony. We are now kind of trying to organize ourselves around a set of recommendations to try to fix this before it becomes law in January of next year. The priority is the incentives because, I wrote to a guy in the US, his name is John Mankey. He was he was an associate of the founder of ESOPs in the US. This is a wonderful guy who created this. He's a lawyer out of California, came up with the idea, drove it through the US Congress. Mankey was his right-hand guy, super young. He's been involved in this for 50 years. He still advises companies on this. And I said, here's what's happening in Canada. Just tell me honestly, if this was the set of rules in the US, using the ESOP, how many do you think would happen there? And he said, well, we do 250 a year here. And I would say if we were to adopt this set of rules, we would drop to an average of 2 to 4. Right. I mean, it's, I wrote another guy and said, what do you think about this? He said, well, if I'm an advisor to employee-owned companies in the US. If I was faced with this set of rules, I would go get my trucking license. Right. I mean, it's that unappealing. Right. So it's frustrating. And we don't, we have we believe there was genuine intent on behalf of higher levels of the Liberal government that truly like this idea and want it to work. We think that over the course of a couple of years, it got a bit lost in the shuffle, ended up stuck in more of a bureaucratic hands, and the result is not reflective of what we think the genuine interest is. And the nice thing is, Anthony, is over the last couple of years, as we talked about this, lots of people have got interested.
Yeah.
Right. We're going in a couple of weeks to meet with a group of dozens of senators who care about this. We know that other political parties care about this. There's all sorts of accounting firms and law firms who care about this. And so hopefully that groundswell of support will cause a change in this approach prior to it being implemented.
So I want to make sure everybody's aware. If you have a question, please toggle over the bottom of your screen where it says Q&A. Type in your question. I'll make sure that that Jon addresses it on this sort of a hot button topic. I had a question. I'd gone around to our staff as I do in our weekly meetings to prepare for these events. And someone asked, I think it's right up your wheelhouse. So let's say a private equity firm were to take over or invest in a private business. Could that structure that then be sold into this employee ownership trust?
Well, they could be, but if you think about how a private equity buyout fund would work, there's a closed-end fund. Yeah. And so in order for them to sell into this structure, they have to lend all of the money to it. Yeah. It might take them 10 odd years to get repaid. That might pose a problem for them, right, in terms of closing their fund. We do see it in the US from time to time, Anthony, where private equity funds are selling into ESOPs. So it does
sell into the ESOP in the US term ESOP, and then the ESOP go and take on additional debt to pay off the private equity or the founder owner in some regard, and then just you pay off that debt. Is that possible? Yeah. So in the US, when a private equity company is considering this, what they'll generally do is seek out a bank who will be willing to fund some debt, right? So let's say it's a business that's not a high multiple business. It's a 6-7 times multiple business, call it, and they can get funded 3 times cash flow from a commercial bank. They'll do that. They'll have enough time left that gets paid out over 4 or 5 years. Then they'll refinance and pay the rest of themselves out at that time, right? So the company itself is never over leveraged from a true commercial debt perspective, but it does happen sometimes in the US. Okay, let me just launch our poll here, and everybody can tell us what a great job you did, Jon, and give us some advice on other topics that you might want to hear about. So I guess in closing, where do you see this going? Do you think that Canada there's a chance that we could catch up? Because clearly the demographics are screaming. I keep track of this carefully. I mean, by 2030, that's going to be the end of the baby boomer. The last baby boomer essentially roughly is going to turn 65. Most of the wealth and the largest portion of ownership lies in that group, and they're looking for transition because some of their children are interested, many are not, and what are they going to do? And I know what it's like. Our firm is employee owned. We have about 15 employees that are shareholders, and we've come up with a system to make that work and continue to grow. And I can tell you that I think that's what one of the secrets to our success as an organization is have everyone, including those that are publishing, to those that are associates and analysts. They're all involved as shareholders. So I was wondering your thoughts. Sure. Look, Anthony, I was very excited to come on this to tell all of your audience about how they can make this work. So I didn't want to come out here and be a wet blanket on all of this, but the policy sort of requires it. The reason why we're engaged in this is for exactly the reason that you described. We are very worried about this transition. Everyone who does a poll on this says that 75% of businesses
are going to sell in the next 10 years for the reasons you've described. And where are they going to sell to? Right? They're going to sell to private equity. They're going to sell to foreign multinationals. They're going to sell to their competitors, increasing concentration of wealth in this country, increasing concentration, corporate concentration in this country. Things we are, grappling with as a society will get even worse. So, we believe that message has got through, right? We do believe that people understand that issue. Even the government name checked it in the budget, quoting that 75% figure. So we think over the next few years, there will be a good employee ownership policy in this country. Will we get there by the end of this year? I don't know, right? To be honest, but I do believe that over the course of the next 2 or 3 years, we'll have something good. We'll have lost a bunch in that time, right? That would have otherwise, chosen this path. But I think there's enough momentum that will have something that people will want to do, within the next few years.
Leave you with our quick snap run of questions here. Your favorite book?
My favorite book is can I give you 2? Is that okay?
2 could be favorites.
So The Entrepreneurial State is a wonderful book about the role of the important role of government in both innovation and growth, right? That kind of tackles the myth that private sector is the one that drives innovation and growth. It's largely not true. Another one is called I'm blanking on the Winners Take All, which is a wonderful book about how who the true winners are in the economic structure and how that all plays out in terms of outcomes for society. He's a guy who was a former McKinsey consultant and a super thoughtful guy about how the world really works. It was a very influential book, certainly for me.
Love it. And lastly, this is my own personal bias, is I'm a big breakfast fan. And so I ask our guests your favorite breakfast and favorite breakfast restaurant. And so why don't you give us your answer, and you can divert that to your favorite meal.
Yeah, I mean, look, I have 3 kids, one of whom is still quite young. I haven't been out for breakfast in like a decade. So I used to love going to Lakeview, but I think that's even closed now. So my preference is definitely so I like to go out for cocktails, Anthony. There's a little bar on Dundas called Project Gigglewater, which is a wonderful cocktail bar, very small, which happens to have a great little bites menu. So I highly recommend Project Gigglewater.
Project, what's the name of it?
Gigglewater, as in like you drink alcohol and you giggle. Yeah. It's
good name, and that there's a whole regentrification going on in Dundas West there. Lots of interesting spots. I'll give a quick plug to a restaurant I just went to yesterday. Had a brunch there, Milagro on Mercer, downtown Toronto here. Wonderful, very interesting Mexican breakfast there. There was a ribeye with 2 eggs on top and some bacon, which like real hardcore kind of bacon. Yeah, it was spectacular.
That is quite a breakfast.
Roast potatoes.
Okay.
Anyway, Jon, we're cheering for you, and all those listening in here. This is definitely something that's a huge opportunity for our economy as we move forward, and something that needs to be addressed. So thanks for your time and your wisdom, Jon.
Thanks, Anthony. All the best.